product I want to go a little deeper into is the level self-funded program, and specifically in the, well, you can explain who kind of the normal average group that you see is, but I'm thinking of the group that has 30 to 150 employees. So just talk us through how the level self-funding works.
Sure. Level self-funding is a concept that came out from the standpoint that when you're truly self-funded, you're going to have premium that you pay for the specific and the aggregate premium. And then you just fund your claims as they come in. And many times employers go, well, I don't know if I want that volatility. I don't know if one month I want to be funding 50,000 and then the next month I'm funding 10. And so the product that was developed is called level funding. And in essence, what that's doing is it's taking what your administration fees are, plus your stop loss insurance, plus your expected claims, and adding those numbers together and saying, that's what you'll pay me on a monthly basis. Single and family, single employee plus one employee plus child, full family, however they decide to do the rates and illustrate them. It's just a flat rate that you're paying me each month. And then each month what the insurance company is doing is they're taking out their admin fees, they're taking out the insurance charges, and they're putting into a claims fund the balance. And so the employer knows exactly what their expenses are on a monthly basis. It is consistent, it doesn't fluctuate. But they're really fully funding the account until the end of the year. So each month they're funding it. Each month the insurance company is taking out a piece for admin, a piece for the insurance cost, and putting the rest into the claims account. And then as claims are issued, as claims are written by the insurance company, they take that money out of that account. If they need to take out more than is in the account, it's on the insurance company. They pre-fund that. And then there's an accounting at the end of the year. So let's say that the insurance cost was $20,000 for the administration. The insurance itself, the stop loss was $50,000, so that's $70,000, and they paid in, $500,000. So they've got that coming out, and then that would say, well, you paid in $500,000, you take out that $70,000, that's $430,000 left, and that was in the claim account, and we only took $330,000 out of the claim account all year for claims. That means $100,000 is going to come back to the client.
Yep.
They would have had that in their bank account, if you will, if you were just in a traditional self-funded.
True self-funded program.
They never would have paid it.
Yeah.
But at least it gives them the opportunity to get the money back, especially if they've got good experience. Again, it's up to the employer group knowing their employees. Somebody's going to get cancer, somebody's going to get MS, somebody's going to have an accident where they're going to have a high claim. And that's why you have the stop loss. And you have that in fully insured or self-insured. It just takes that, that gigantic hit away from the experience and only sets a certain amount towards the experience. Yep. But a 25 life group, a 30 life group, a 40 life group, that's a product. The level funded product is a great stepping stone. And then over time, sometimes we find that the employer group says, I'm going to go fully.
Ready to go the full.
I'm going to go the full tilt.
Yeah.
Because I don't then need to comply with some of the plan designs, et cetera, that I do in a level funded.
Yeah.
Many times the level funded, the plan design is the plan design. The insurance carrier sort of determined how it's going to look compared to when you're fully self-funded. You can